Hello and welcome. I'm Nick Rohn, Director of Technology for the Asset Leadership Network, and I'm excited for a special program. This is the launch of the ALN Insurance Asset Leadership Board, and we are excited for this program titled Leveraging Enterprise Asset Management to Optimize Property Insurance and Risk Management. And you can see our panel there. But before we get to that, we just want to thank our patron members, Jacobs, Mantech, Onuma, ABS Quality Evaluations, and CGI, as well as all our organizational members. And again, we're trying to grow this list. So reach out if you're interested in working with the ALN. You can see University Health is in there. We're really grateful for all these members. Everyone brings a different angle to solving the big questions. And so we're really proud to be working with all these organizations in the thought leadership department. And with that, we'll say we have an upcoming event with the Australian Asset Management Council, and that's June 18th at 6 p.m. for our Australian colleagues. So, and of course, we'll have ALN Thursday at 3 next week. We just haven't nailed down a speaker, and I think one of our members, Facil AI, is going to be speaking the following week. Mike, Executive Director, welcome.
That is correct. And we've got a couple ALN senior fellows who have worked to put together a program in July. Boy, we're already coming to the end of June and booking into July. And I was telling Nick, we're coming up on our 5-year anniversary of doing this. So thank you all for your support. And like Nick said, this is a very special program, the launch of an insurance asset leadership board. And we've been working on this for a long time. And we believe that insurance will connect dots to financial savings in ways that top leaders will understand and will act on. So we're very excited about this program, which is going to be kind of like a board meeting that you can watch and participate in. We really want you to be active in the chat, please, with questions. We've got some broad concepts we're introducing, and this board is going to have specific programs in the future based on the type of information that the audience is responding to and would like to hear more about. We've got some things, but let's get rolling with this. And it's my pleasure to introduce Art Kurland, who is an ALN Senior Fellow and Director of Capital and Asset Management at University Health. And Art is the person who got us rolling down this a while ago. Art, what was your reason to connect insurance with asset management?
So hi everyone, I'm Art Kurland, Director of Asset Management for University Health. If you're interested in learning more about University Health, please visit our website. It's universityhealthsystem.com. So this journey actually started like 20 years ago to get to this point. And for the sake of time, I'll try to just summarize 20 years of effort into like the next 2 or 3 minutes. So my background is in accounting. I used to work for an organization in Florida, and as you probably are aware, Florida is probably the hurricane capital of the world. And so as I was responsible for the what's called the fixed asset register, that's the asset listing that supports the values on the company's balance sheet, financial statements. And so I over the years was involved in several hurricane claims, and the work to gather all the information that the insurance companies required was very detail oriented, very difficult to go back and find records, because a lot of the assets that were destroyed were older, and finding records was very difficult. So that was like my introduction to insurance and covering assets that had a claim on them. and it wasn't a pleasant experience. So I kept that in mind. And as I progressed in my career, it was a topic that many of the financial leadership CFOs that I would interview with was very interested in cleaning up that fixed asset register that I mentioned, because most of the time it's very unreliable, and it's really not used as an inventory system. It's more of a depreciation system. For example, a lot of companies, and it's perfectly acceptable within GAAP to have one line item for multiple assets versus having an inventory system would have each individual asset laid out. And so that was part of the problem too in gathering information for the insurance companies during the claims. And so I always kept that in mind throughout my career. I started my own inventory company just based on that need, and serviced a lot of organizations in that way, helping them clean up their fixed asset register. Um, and then I started talking to insurance brokers, and I asked them how, just in general, how important it was to have a accurate listing of an organization's assets when it comes time to put in a claim. And of course, I was told that was asset management 101, very extremely important to have that, and introduced the idea of maybe having a discount on premiums for companies that have good fixed asset or inventory records. And I've been chasing that dream ever since, trying to find those insurance companies that would offer a discount on the premium for organizations that maintain their assets and can and have it documented very well. And so, Paul, if you want to take it from there.
So your journey brought you to Paul, and you brought Paul to the Asset Leadership Network.
Yes.
So
Oh, Mike froze.
thank you for starting this off with that perspective of the owner. Paul?
Yeah, no problem. Hi, guys. My name's Paul Chaben, and as Mike just said, I was introduced to ALN, I don't know, maybe 3 to 4 years ago now, and I knew Art before that because based on what he was saying on the legacy of his career, we interfaced on some things because the company that I was with at the time had an expertise around validating those assets at various organizations and creating very strong cleansed and fortified information for fixed asset accounting and management. More for the financial reporting aspect of it. It's only been recently where I've been exposed to the whole insurance ecosystem, and along the way, the professional services avenue that I've gone down has really refocused on valuing assets. We still help validate fixed assets through inventory and electronic code tagging of assets and so forth. But the focus has really become more on valuing assets. And the company that I'm with, GA Valuation Advisory, has a broad focus on various valuation objectives, including insurance valuation. And that's where a very myopic focus of mine has been in the last year and a half to two, let's say. And that led me to meeting Aleacia a year and a half or 2 years ago. And we have a lot of overlap in terms of what we're trying to accomplish from a business development standpoint. And so we've had some really great synergies to build upon and are still building upon those. And so we've had a great working relationship, and I wanted to bring her into this conversation.
And boy, what excellent move that was. I want to emphasize that we've been meeting for years on this. And Paul and Art have brought people who have helped us understand and advance this concept. But it wasn't until Aleacia joined and her dynamic energy came and her instinctive understanding of the connection between asset management and insurance that just exploded, just blew up. And it's so great to welcome you, Aleacia. Will you give a little bit of an introduction about yourself?
Yeah, thank you. That was so nice of you guys to say. Thanks. And thanks to everybody for joining. I'm really looking forward to this discussion. It hits at the intersection of two worlds, which I find super interesting. It's the people who own and manage assets, and then those who kind of underwrite and price it. Myself, I'm Aleacia Perdomo. I think you mentioned my name. Over my 30-year career, I've worked across the entire ecosystem of the risk transfer process. I spent time as a technical property and casualty underwriter at one of the largest global insurance carriers. I worked for the second largest major consulting firm in the world in a client risk advisory role. And now I work with these technology platforms that really serve the broader risk management community. But this path has given me such a good grasp on everyone's strategic objectives and agendas. But it also gave me a deep appreciation for the challenges that the asset owners face because they're tagged with trying to connect real world data with financial outcomes like premiums, deductibles, and recoveries after losses. So what I also learned over my career was a new language of insurance. So I'm going to do my best and not use industry acronyms, but if I slip up, please stop.
Okay,
That's all right.
I will catch you. I will catch you.
And
Okay.
I'd like to say you're working with a woman-owned company that is
Yes.
really growing. And can you show
Yes.
us the logo on your wonderful sweater?
Well, yes, I can. And hopefully you can see it on my virtual background.
Yes, there it is.
Yes. So yeah, I work for SnapRISK. What do we do? We're unique in that at a high level, we're kind of a two-pronged firm. First, we deliver world-class risk engineering services, meaning boots on the ground, HPR property consultants across the globe.
HBR.
HPR, oh, I'm sorry, highly protected risks. Those services, in a nutshell, would apply to your what we call occupancy risks. So that's going to be your manufacturing, your energy, we call them harder occupancies. On the other opposite side of the spectrum would be your softer occupancy risks, and that's going to be retail, municipal risks, restaurants to some degree, etc. So that kind of sorry, you're right. I used one. So yeah, so we've got experience across all industries. And I mentioned a couple: public entity, municipality, education, manufacturing, energy, to name a few. And our services range from everything from specialized risk assessments, infrared scans, probable maximum loss estimates, etc., to kind of a simpler version of custom property data collection that's going to be tailored to what the underwriting and the modeling and the compliance needs are for the organizations. And in terms of clients, they span throughout all the channels of the risk ecosystem. We work with brokers, carriers, risk consultants, advisory services. We have direct client engagements. We also have some cool services that support first insurance responders and TPAs. So that's the first part. And then the second part,
TPAs.
Third-party adjusters. My bad. You're right. Third-party adjusters, property adjusters. These are the bad guys. These are the guys that come out and adjust the loss, and they tell you, "Nah, we're not going to cover that," or maybe we'll talk about that after. But the second piece to what we do is that we're also a technology company. We have proprietary platform that gives our clients a geospatial view of their entire portfolio that includes all the data that we collect. If you have appraisals, they would be stored there. And then we have a suite of apps that clients can actually manage and visualize critical data right through the app. And that would include COPE data, which I will define in a minute. Construction, occupancy, protection, and exposure is what that stands for. And then it also manages things like recommendations, impairments, hot work tracking, and can even layer on live weather alerts. And it's all one interactive dashboard.
So Alicia, that's a great segue into maybe getting more into the nuts and bolts of what we're here to really convey today, and that is, who we're talking to are asset managers, and asset managers that are heavily ingrained in this thing we call ISO 55001, which tends to have a bent towards operations and maintenance and facility management and so on and so forth. And so the insurance aspect of this and the data, which you've alluded to so far a few different times, which is so important to helping optimize the insurance coverages and rates and terms. Let's dive into how the asset management aspect of this relates more to insurance data and what we're talking about in terms of the types of data that we need to incorporate into optimizing the insurance.
Yeah, I think that's the perfect place to start. And I think, you just laid it out, right? The ISO 55001 gives you that framework for managing assets across the life cycle, things like condition, performance, and value, which is essential for operations and long-term planning. But when it comes to insurance, the needs are a little more specific and more granular, because insurers are looking at property through the lens of catastrophe risk. They need to know not only what you just mentioned, but is the roof wind rated? Is the building elevated above base floor or flood elevation? Has it been seismically retrofitted? That level of detail typically doesn't live in the standard asset management system, but this is where technology can play a critical role, right? Because aggregating data from different systems, verifying it, and most importantly, producing structured outputs that underwriters can work with more effectively is going to be critical. So I like to think of it as transforming your asset data into what I call risk grade documentation, because when that's supported by site verification and visual proof like photos, reports, and data exports, that becomes the kind of evidence that insurance markets actually trust, and trust is going to lead to better outcomes.
And so that's a great succinct way to kind of establish the basis for this discussion. And so to the asset managers that are watching, who in their organization do you feel is the most critical, and maybe not just one person or one area, but what's the most critical area to start to collaborate with in terms of how they're tracking data versus how to fortify that data with the insurance aspect of this?
Well, I think your risk manager is going to obviously have the COPE data and the statement of values. So I think before I get into that, because I think it's a great question, I'm going to assume that a lot of folks don't quite understand what a statement of values is or what's contained on it. So can I just kind of briefly explain what that is? Would that help?
Yeah, and the statement of values you're saying is handled within the risk management area.
Typically it is. Yep. So,
And-
so a statement of values is more than just a spreadsheet, right? It's going to be a detailed schedule that includes the declared value of your real property. And when I say real property, we're talking about building and business personal property, which also could include stock and equipment. It's going to outline your business interruption exposure, which is loss of income, or it could just be continuing expenses or a combination of both. And then most importantly, the COPE data that underwriters rely on to assess the risk. So I'm going to define COPE in more detail for those of you who do not know, but I'll start with the building value, because the building value is something that is directly correlates to how asset managers track things, and kind of a big hot topic in the business right now, which is valuations. And I think the question that I would ask the group is, who determines the building value today? You know, in many cases, the building's replacement cost is captured figure that's kind of been carried on year over year, sometimes without proper trending or validation. And this is a problem because if the value is off, every downstream calculation is too. And I'm going to get into some of those calculations in a minute. This is why periodic building appraisals, I say periodic, ideally every few years, are really essential. And they help reset that baseline and ensure that your insurance coverage reflects the current replacement costs and not outdated estimates. So once the building value is established, underwriters then look at COPE data. COPE, C, construction, what materials were used for the roof, the walls, the floors. Sorry, you look like you're going to ask a question, Paul.
One quick insertion on the going back to value for a second.
Yep.
And you did say it, but I just want to reinforce it. We're not talking about book value that's on the books, or that may have been the original purchase cost of the asset that a facility manager might be tracking, or an operations manager, but rather the replacement cost. And you said that. So, but we're talking about needing to trend and oftentimes recertify the replacement cost of a building, because over time, as construction costs inflate, that needs to change and get updated in the insurance documentation.
Right. You're right. They're two different things. Most of the time, a statement of values is going to capture the replacement cost value, because that's what the insurer uses as the basis to calculate the premium, and the contract terms and the co-insurance. So we'll get into that in a minute. But back to COPE. So you've got construction, occupancy, what's the building used for? Protection, P, are there sprinklers, alarms, central station monitoring? Are there fire resistant features? And then exposures, is the building located near natural or man-made hazards like rivers, highways, wildfire zones? That's what we mean when we talk about COPE. And it's an acronym that's widely used in the industry. And I think everyone should kind of know that. That one you learn in Insurance 101. The COPE data feeds directly into the market's catastrophe models. Okay. The catastrophe model ultimately drives risk selection, capacity, and pricing. And we'll get into that in a minute. But here's what a lot of people don't realize. The best models today are designed to actually go deeper. So they can ingest a wide range of both primary and secondary building data. The COPE information I just described is what we would call basic COPE data. But if you go beyond that and you gather the secondary building data, and those would be things like roof geometry, wind uplift ratings, seismic retrofits, flood elevations, building envelope protections, those types of things, that deeper layer of insight can dramatically improve how your risk is modeled. And that can ultimately unlock more favorable underwriting outcomes. So that's a big deal.
So would it be safe to succinctly say that like with almost everything else in business and management, you want better data to portray a more clear picture of the property, so that the underwriters of the property that are going to establish your rates and coverage and terms for losses has a much better way to assess the risk of that property, of a loss for that property. So that's where
Art, is that what you were saying at the very beginning, Art?
muted.
Yes, I'm sorry. Yes, exactly. So just a couple of things about, first of all, the ISO 55000 and why I think that's so important. I'm not sure if everyone knows, but University Health is ISO 55001 certified. And from and back to that question of who is responsible, it may be different departments that are responsible. And so that's where I feel the ISO 55000 is so important, because it forces these different departments to work together to get that information that's required.
Right.
So what happens once the data is collected for the catastrophe model?
Okay, so that's a great question. I'll start by saying something I learned early on in my career, and that is all models are wrong, but some are useful. Start with that. So once your property data is fed into the catastrophe model, it's going to generate two key outputs for the underwriter. The first one is the AAL, or the average annual loss. This is the long-term view of expected annual losses. The second one is going to be what we call the PML, or the probable maximum loss. And this is more of a big event scenario, like a 1 in 100 year or a 1 in 250 year loss. So underwriters take those numbers and then they calculate the premium using a general formula that looks something like premium equals the average annual loss times a load factor plus the fire factor plus engineering costs plus claim handling costs plus profit. That's how they build your premium in a nutshell. I mean, we could go deeper, and there's a lot of variables, but the key takeaway here is you can't control anything in that equation other than one thing. And that one thing is the quality of the data that's driving the modeling. The very data set that goes into the model where they arrive at the AAL and the PML. If your data shows better wind resilience, higher elevations, or superior protection, the model is going to reflect lower estimates. And that's going to lead to better pricing, more favorable terms, and even more market participation. Something else a lot of people don't know is blanks actually get penalized in the catastrophe models. So something is generally better than nothing. And that has to do with the algorithms and the confidence intervals that are set forth in the AIR and the RMS models.
And Aleacia, when you say market participation, can you expand on that a little bit? Because we haven't really talked about brokers and carriers and stuff like that. So maybe you can expand on that a little.
Sure.
And
Yeah, when I
also,
say
Lisa, could you also expand a little on that claim handling cost?
Sure. Yeah. So first question on the markets. What do we mean by market selection and market capacity? When a broker submits your risk to the markets, the first thing you need to do is be the best that you can be presented in terms of backing up your data and being credible so that the markets will select your risk. They have to make a decision every day on where to deploy capacity and how to price that capacity. So you want to generate, I always call it like a feeding frenzy. You want markets to be fighting over your risk. You want them to say, I want that account because that is cream of the crop, right? That's what we want.
And when you say, and so these insurance carriers, the assumption then is insurance carriers only have so much capacity to insure property.
That's absolutely correct. And the capacity that they put up on any one given risk is 100% driven by the AAL, the average annual loss, and the PML, probable maximum loss, that one thing. So they have treaties on the back end that they have to abide by. So the markets are going to say, okay, we're only going to retain the first 30 million of any given risk. What is the probable maximum loss on this account? If it's 40 million, right? It modeled to be 40 million because of bad data, then you're not going to be able to get one single carrier to put up that capacity. It's going to be shared and layered, or your carrier is going to need to go and buy facultative reinsurance for that 10 million excess of 30 million, which is they're going to give that price to you. So you're just adding on costs. So that's what we mean by capacity deployment and risk selection and how that impacts everything. So it's all interrelated. I said earlier that that one statement of values and all the data drives all the downstream decisions that go from there. And people don't kind of understand. If you've never been an underwriter, you wouldn't necessarily know that. So it's important because everything comes from that. When we say driving better outcomes are going to be things like better capacity, more markets that want to participate, better pricing, more favorable terms and conditions, hopefully no co-insurance if you got your values right. You know, all those things come into play.
And let's come right back to Art's question on claims, but I just want to make a quick comment as to Mike and Art, why we have had, based on what Alicia's been explaining, it's kind of becoming more crystal clear in my head as to why it was so difficult to get to this point today that we were at 3 years ago, when we were at 3 years ago, trying to figure out how it, you know, on the surface, it made so much sense that if you're a good asset manager and you've got great information about your assets, you should be able to get better insurance rates. But it's a lot more nuanced than that. And so we're really adding on additional layers to what the asset management solution should be for this.
I think Art, you had a question around the one variable in that equation, which was the claim costs, right? So we'll talk about program structure in a minute, but if you're looking at a bundled insurance program where the carrier is providing the claim adjusting, then there's a load in there for that, right? They're going to charge a fee to do that. When you're using a TPA and it's unbundled, then the premium is not going to include that. You're going to a separate TPA service, and that's your load that you've got to plug into that equation.
Third-party administrator.
A third-party administrator, yes. Does that answer your question,
Yes.
Art, or were
So,
you trying to?
Yeah, I was trying to find out if just in my mind, just the words claim processing it's kind of like a time is money kind of a thing. And so I was thinking that if your information is well organized, it would just take less time to process, which would mean the cost would be less.
You're right. Well, in theory, when you're talking about your claim load in that equation, it's a combination of the loss fund, right? Whatever your loss pick is, right? They set aside an amount that they're gonna say, okay, we got to set aside $30 million on this risk every year to pay losses or whatever the number is, plus the cost to adjust or the expense handling fees. So to your point, Art, if you're so much more organized and you're able to drive efficiencies through technology in terms of, you know, your values are there, your adjusters, everybody's on the same page, there's efficiencies. In theory, your cost of adjusting the loss should go down. But is the carrier going to give you a break for that? I don't know. That's the big question. On an unbundled program, they might. You know what I'm talking about, Art.
Yeah, exactly. That's why I was raising that.
This is a good time to address a question we have. Someone who is inexperienced in insurance, and her university deals with a large corporate insurance group, but they also have some self-insurance. And this person wonders how to connect to the corporate risk office from the asset management office before things go south, because usually corporate risk is when things are bad. So we're talking about making that connection to improve things. And is there anything that you can say? Well, I also want to say we're going to have other programs coming up, and this could be a program in and of itself in the future.
Oh, yeah.
So this kind of comments, this is exactly what we want to be hearing.
Yeah. I mean, I think in terms of how an individual organization works together across those disciplines, it's hard from the outside to really, you know, say how you guys could come together. But I would probably lean on your broker and your risk consultant to get the right people involved, because there's a good chance that there's folks at the, you know, or other consultants that are working with those other teams like HR. There's some things that tie into all this with HR and with when you start thinking about liability. And they have relationships in those other departments and those other disciplines. That might be a good starting point, but
And
Hey,
Art, as an owner, you're doing this, I suspect.
Yeah.
How do you
Art.
engage with your risk department or insurance department?
Is that directed towards me, Mike?
Yeah.
So I don't really engage with them a whole lot. They're part of our stakeholders, so we keep them informed of what we're doing. I normally don't get any questions from them, so
Case in point.
yeah.
Does it, well, Art, let me ask you this, because yeah, and you touched on it earlier. You said how the ISO 55001 framework drives the connectivity to the different silos in the organization that need to collaborate or should collaborate. Um, Based on what you're hearing today about the types of data that needs to be captured for optimal insurance of property. Do you feel like that should fall on your area of the from an asset management perspective? Um, I guess if the risk managers are tracking that information in whatever tool they have, um, where would there be synergies in including that information in your asset management platform?
I think that depends on the result of our efforts in getting lower premium rates. I mean, if there's a reward for doing it, then yeah. Like everything else, I mean, is the effort worth it? So, like for example, we're building some more hospitals, and one of the requests from one of the facilities people was to gather, useful life information, warranty information, uh, registration, preventive maintenance records, serial numbers, things like that, in those heavy equipment type of assets. And so, and that involves procurement people to help with that. It can't all be laid on the desk of one department or person. It's an organizational effort, which is the beauty of the standard, is because if you don't do it and it's part of your objectives, then you just don't get certified.
So theoretically, then, as you're building a new hospital, and you've made your risk manager aware, or the risk manager should be aware of that as well. If there's a particular source of the information about the building specifications, they that should the capture of that should include some of these additional COPE pieces of information that Aleacia has been talking about. Is that something that you think could be incorporated into a consolidated effort?
Yeah, absolutely. It sure can. And, and so at the hospital, there's multiple risk management areas because, one of them is with patients.
Right.
So, yeah. But yeah, absolutely, it can be done. No question about it.
Because that's something to think about in terms of, because I always think of asset management, Mike, in terms of one big repository of information um, that can feed the different disciplines across the organization in terms of what they need to do their job effectively. And if risk management isn't included in that today, they should be.
Yeah, and I've found too that with asset management, it's very difficult to go back to get information. on assets that are already in existence. So when you build something new, like a hospital, it's always a great opportunity to start and then move forward, because the older stuff's eventually going to go away. So the sooner you can start capturing good information, the better, because over time it's all going to be good.
Yeah, I would just add, the best results are going to come when all the roles are aligned, right? The CFO, the risk manager, and the asset manager. Because the asset manager, he's going to know the age of the building, the renovation histories, the major capital improvements. The risk manager is going to be closest to the statement of values. They're going to know what buildings are covered, how they're protected, how the data gets submitted to the market. And the CFO is thinking about, we didn't talk about the CFO. CFO is thinking about long-term financial goals and smoothing volatility, managing reserves, and optimizing capital. So when those three folks collaborate, if they use technology tools that structure and evidence the data, then you're going to be able to negotiate smarter insurance programs and avoid some of those co-insurance traps, and build strategies that are going to be both resilient and financially efficient. That's really it in a nutshell.
Aleacia, that's music to our ears. We're all about connecting the people who are making leadership decisions, and you just tied it in a bow right there. So how does all of this relate to the insurance program structure? And maybe that's something for Paul to jump in with first, or Aleacia?
I think that one's probably me, just because of the insurance piece. When we talk about program structure, we're referring to deductible, retention, limits. If there's a captive, are there retention layers, all of which stem from modeled losses. So if you don't learn anything, I hope you took that away. Everything stems from the modeling. Those structure decisions directly influence capital planning, reserves, and budgeting. If you improve your modeled risk, you might be able to retain more risk internally, which in turn, you're going to be able to reduce frictional costs, and maybe create tax advantages by shifting risk in a different way. We've seen clients restructure their entire program after they improved their SOV, because the stronger data led to lowered modeled losses, which in turn allowed them to simplify their tower and attract more carriers.
Can you say that again? I think
Yeah.
that's like the nutshell of it.
Yeah, I mean, we've seen clients make a major change to their program structure after they improved that statement of values with better data, because the better data led to modeled losses, right? And when you have better modeled losses and you're making a more educated, data-driven decision around where at what point you're transferring the risk to a carrier, or at what point are you keeping it internally, that's something that can come of that. But most importantly, we've seen clients simplify their whole tower, meaning maybe they had 10 carriers on a property program, and now we're able to just go down to one or two. And that's a big improvement when you see a program structure simplified like that, because there's all kinds of things that can come. We won't even get into it with having different carriers and so forth on a program. So,
and that addresses the question from the University of North Carolina of how asset management can help the risk office directly. But we still want to have a special program and maybe even talk with University of North Carolina specifically, but we'll save that for later.
Aleacia, would you? Oh, go ahead. Go ahead. Sorry.
Or Paul, did you want to comment on that? Or Paul, did you want to go on to the next question?
I was going to ask about that tower briefly. When you say tower, would you say that captive insurance is sometimes part of a tower, or is that a completely separate insurance idea?
So when I use the term tower, this refers to limits. If you have a statement of values that has $100 million in total insurable values, you might choose to buy $100 million of insurance. There's all different ways to evaluate it and decide, but for just to keep it simple, the tower refers to building the limits or the coverage for the total to cover the total insurable values. So that's what we're talking about when we say tower.
And is
captive-
captive insurance part of
a-
that sometimes?
A captive, you could also have a tower to build in a captive. A captive in a nutshell is just a insurance company, a little mini insurance company that you build.
Right.
We could have a whole session on the mechanics of a captive, but you're kind of doing the same thing. You're just doing it for yourself as the insurer.
So captive insurance, is it equal self-insurance or is it a little different than self-insuring?
That's a complex question. There's all different structures of captives. There's rent-a-captives, there's shared captives, there's single cell captives. There's all different structures of them. And quite honestly, I am not an expert in captives. I know enough about the mechanics to be able to speak to a client and say, yeah, you would be good for one, or no, you probably wouldn't, and then bring in the experts. So
Okay.
if you guys, I could definitely bring experts if we want to have a session on captives.
Okay, yeah, that was a little bit of a tangent, but I only wanted to bring it up in the sense that some of and captives might really be more valuable for for-profit companies because there's typically a tax advantage to that, an income tax advantage to that.
But the concepts are the same, Paul. You still have to build and set rates. And so again, if you learn nothing, I hope you learned, rates are all based on modeled losses.
Right.
That's the only piece you can control in the equation, is the data that drives the models, that delivers the PML and the AAL, that drives everything from there.
So whether you self-insure or go through carriers, you have to model the losses to be able to either get the right coverage or fund the right funding for possible losses.
Yes.
Yeah. Okay.
And that leads to something that Art and Aleacia have touched on, which is, the importance of valuations. But why is it important to have current valuations?
That's a great one. So valuations impact almost everything, right? They're going to impact financial reporting, tax compliance, replacement cost factor into funding and reporting, model accuracy. CAT models rely on accurate insurance to value ratios. Valuations impact loss payout because of coinsurance. So if you're underinsured, you can face claim time penalties. Art, you mentioned going through a hurricane. I would be really curious to talk about coinsurance penalties and your experience with that. But it's the reason why third-party appraisals are essential, because they ensure proper coverage and they send a signal to the market that your values are defensible, right? It's going to be hard for a carrier to say, hey, you should be insuring this building for $2 million if you have an appraisal that says it's 1.8 million. So I'm happy to quickly explain how coinsurance penalties work in case that concept is new to everyone. I mean, I can keep it really high level, but it's relevant to this discussion. It's up to you.
Well, if you think it's relevant.
Well, yeah, I mean, they impact loss payout, right? So I'll give you an example. There's a formula. The formula is, it's what you insured the building for divided by what you should have insured the building for times the coinsurance factor. That's all on the denominator of the equation, times the loss. That's the formula. So if you've declared on your SOV that the building is $600,000 and you suffer a $200,000 loss and your contract has an 80% coinsurance clause, what that means is that the insurer is going to pay $150,000 on the loss minus the deductible. So here's how it looks. 600,000 divided by the replacement cost is $1 million. That's what they're going to calculate it. The insurance company is going to say you're insuring it for 600, but it should be $1 million. But the co-insurance penalty or the co-insurance clause is 80%. So $1 million times 80% is 800,000. So 600,000 divided by 800,000 is 0.75. You take that factor times the loss, 0.75 times 200 grand. That's 150. Now you deduct the deductible. So I've seen a lot of very angry clients after hurricanes. If you're not keeping up with trend factors, you're not trending your values, you're just looking at old SOVs and old asset data, and you're not keeping up with that, you're going to get burned if there's a storm. Art, do you have anything to add to that?
Well, from my experience, and I have to remind you that this was, when I went through this, I was a lowly staff accountant doing all the, pretty much the grunt work and trying to find the information that, the insurance companies wanted. And this was, when computers were running on DOS, so it was all paper. It was a horrible experience back then. But today's technology, I think, could make it a lot, would be much more efficient.
I wonder how many people on the line on this webinar know what DOS is.
So somebody wants to know, is this called underinsurance?
Yes, that would be called underinsurance. If you're declaring a building for 600,000 and its replacement cost is $1 million and you have an 80% co, it means you have to at least carry it for 800 or there's a penalty. And that's how that penalty works. I've seen worse. I have had clients that went through storms and they had $1 million loss and the carrier paid 500 and they were mad. So valuation's a real thing.
Yeah.
And
So another part of that, and further on in my career, when I was working with appraisals, I was told, through the dialogue and conversation, I was told that by the appraiser that a lot of organizations overpay in property taxes because they don't know what their valuation is, and so they just pay extra to avoid penalties.
That's interesting. I haven't heard that one. I can tell you that from a carrier's perspective, they don't want to overinsure either. So they're gonna tell the carrier's gonna push back and tell you if you're.
I mean, the companies, the organizations overpaid
Oh, yeah.
because they didn't have accurate valuation
Overpaid
records.
taxes, yeah.
Yes, on property taxes.
Paul, do you get into that?
Yes, that's a huge part of, so not to go off on a big tangent, but this discussion around the data and all the importance of having the data, especially around the equipment records that Art was talking about during the hurricane, and properly reflecting what's on the books versus what's in the facilities is a big major issue that we help companies adjust and get good audit trail for, because that's important for not paying property taxes on things that don't exist.
So what are some of the other values from this having the better data?
Well, it's a cyclical chain reaction, quite frankly. Better documentation is going to lead to better risk selection. Better risk selection leads to more accurate modeling. More accurate modeling leads to lower AALs and PMLs, and lower modeled losses will improve pricing, capacity, and structure flexibility. And all of those things support budget goals, reserve planning, and tax strategies, to your point. And all of it leads to fewer disputes and faster claims. And it all comes from having solid, trusted documentation up front. So each piece reinforces the next. It's not just about reducing cost, but it's about building more resilient and predictable financial posture. And that's what every organization wants. everybody's strategic objective.
You're
Yeah.
bringing a big smile to Art's face. Look at that.
Is that good?
Yeah, well, Alicia, the other, is it also safe to say that, to your point about it's not all about cost, it's about reducing exposure to loss.
That too,
Yeah, and
1000%.
so you want to pay more in cost to have a credible insurance program that avoids major losses.
I would like to wrap up with all of you providing one example of what people can do right now to help with their insurance through asset management. But Art, I gotta ask you to start and start by saying what made you smile so big when Aleacia was talking there.
Well, I I just kept thinking to myself that this kind of blows apart the notion of the answer to a simple question is a simple answer. I mean, you know, the question is initially, that is, would better asset management lower insurance premiums? And what a complicated answer.
Well, the answer is
Shorter
yes.
answer is yes.
Yeah,
And she
okay.
stepped it through a
Yeah.
process that is grounded and well connected. And I got to tell everybody, like I said, Alicia's a dynamo.
Well, then let me just rephrase. The
Sure.
reason the answer is yes is pretty complicated.
Mhm.
Yes. Okay. Yes. But Aleacia has spelled it out. And what she has spelled out, we're going to work to put into an ALN white paper that has this for you to bring to your risk department or your insurance carriers, etc. So the ALN Asset Leadership Board is going to start producing products and content in this vein that will help greatly. So so one thing that people can do today or tomorrow to help connect their asset management to insurance improvements. Aleacia?
Okay. Sure, I'll go. So I would say start with your statement of values. Pull it out. Ask yourself, how complete and accurate is this data? Can I confidently speak to the roof type, the construction materials, the elevation, the protective systems for every location, and then take it a step further and identify the locations that are actually driving your insurance terms and pricing. So those high value or high risk properties tend to have an outsized impact on your modeled losses. So prioritize those for deeper data collection and validation. And then from there, map out what I call a data improvement journey, which might include commissioning a third party to do validating and to close those data gaps. Bring in vendors who specialize in risk relevant property data, especially the type that insurers and CAP modelers rely on. And then technology would be the last thing. Technology can really support this effort by centralizing, visualizing, organizing, evidencing, and updating data across teams. Ultimately, the goal is to move from reactive insurance buying to proactive risk strategy, where your data tells the clear, credible stories and earns you better outcome with pricing and protection for your organization.
That was really well said, and I'm going to add to that in a shorter way that says, in addition to making sure you do all of that data updating and try to incorporate some technology around that, also and incorporate some third parties to help with that. Those third parties could be very helpful in going on site to do the exercise to improve that data, update the valuations, but most importantly, while doing that, we've already alluded to some other ways to just tweak that effort so that you can add on to the value of that effort by looking deeper into some other issues that will get you some better cost containment, like the property tax, like other maintenance and repair and operation contracts. There's a host of other things that can be done in connection with this type of field inspection that can pay for that field inspection.
Art, you got us started in all this, so it's appropriate for you to have a last comment about what people can do.
So like I said, ISO 55001 is really a great place to start because you can kind of set your own goals. You don't have to have a large scope in being certified. You could just start with something simple, just like knowing where your assets are, having a complete inventory, and then starting by finding out what type of information is useful for the insurance brokers and agents, and just start from day one and go forward. Not, you know, if it's easy to go back and get information, then by all means do it. But just start, and over time you'll have clean data, valuable data, useful data, and it may take a long, a few years to get it, your whole inventory at that level. But so what? You just got to start.
Okay, just start. Well, Art, thank you for starting us down this path. Paul, thanks for being a champion to keep this going. And Aleacia, welcome to the Asset Leadership Network. You are really bringing the energy to us, and look forward to working with you on turning your very thorough notes into paper for other people to easily understand this, and to work with you and your colleagues at SnapRISK on specific programs on solar and the risk of fire and how to avoid those risks. There is so much that we can be doing. I look forward, and I thank you all. And I thank the audience for your enthusiastic engagement in this program. And I put a note that if you want to get on the list for the white paper, please send an email to info@assetleadership.net. Look forward to our program next week with the value and benefits from asset management, which continues the asset management and corruption series, how asset management helps avoid corruption. If you're avoiding corruption by understanding what assets you have, I bet you could even reduce your insurance risks a little bit. See you at next week's ALN Thursday at 3 also. Thanks, everyone.
Thanks.
Thank you.
Bye.
Thank you.